Just to start, for those of you who may know me or who may not know me, my name is Adam Pilanc. I've been director of Step-by-Step Financial Solutions for over 10 years, been involved in property markets from 2008, both as an investor and as an estate agent previously. What I'll try to do is I'll try to give you a bit of an overview and flavor of how this property investment could work moving forward. A few of interesting strategies, some of the things which I'm using as well in my own personal journey. So just quickly touching the base on what we're going to cover today and what's the purpose of the session today. So the main purpose of the session today is just to introduce you to the idea of property investing. We're going to explain the risks, some good and bad things about property investing, ideas about getting the funds, how you can diversify the risks in relation to your current profession, and how you can actually move your money from one place to the other, not to keep all the eggs in one basket. What's quite important as well is what are we not going to cover today. We're not going to be talking about any alternative investment vehicles. We're going to focus on properties today. I'm not going to tell you as well that the property is the best and the only strategy where you can actually build your wealth moving forward. It's just one of many. And what we're not going to be talking about today is a short-term investing, speculation. What we're going to focus on today is a long-term strategies. So you can predict your kind of income and the growth moving forward. So we just had a quick introduction. We're going to talk briefly about the history of the property market, what to consider when investing in properties, how to fund your investments in the property market, briefly about return on investments, strategies for management, and we're going to finish with some Q&As, as Bart mentioned. If during the discussion there are any questions, pose them. I'm pretty sure Bart will actually pick them up and we can answer them later on. So just a bit of a regulatory information. We are not going to be giving any individual advice today. We're going to be talking generally about property investing. Before deciding in any type of investment, you have to consider your individual circumstances, potentially seek a tax advice or talk to a qualified mortgage or investment broker if that's your route of investing. So Step-by-Step Financial Solutions is an appointed representative of Stonebridge Mortgage Club. We are regulated by Financial Conduct Authority. You can find all the information about regulatory stuff on our website, www.sbsfinance.co.uk. And I need to mention as well that not all buy-to-let mortgages are actually regulated by Financial Conduct Authority. So I think a good starting point would be what to consider before actually thinking about investing in properties, because there are various things which people will be looking at. So what is your main goal, really? Are you looking to invest in perhaps a single family homes, HMO investment, holiday lets? This is a very important decision for investor, because when you're investing and when you're actually working, you're trading your time for money. So when you're looking to invest your money, which you've actually made from the various other sources, you need to think about the amount of time you want to spend additionally to what you do currently. So some people will have a strategy where they buy just a single family homes, they're renting to the families. The return may be slightly lower than on other investment vehicles. However, this strategy may not require a lot of your time. On the other hand, some investors will be very keen to look at HMO properties. That's where you're actually renting a whole property with individual rooms. Potentially, you can get a better cash flow, more return in your investment. there's probably more management involved in that sort of investment. Some people will be looking at the holiday let for various reasons. They may think about using this property occasionally themselves. There are very high return potential with Airbnb and Booking.com these days. And there may be as well more management involved and slightly higher risk. So you just have to kind of make a decision whether I want to get really involved and maybe treat it as a part-time job, or do I just want this property to be a side hustle which doesn't involve a lot of work. Another very important decision is to think about what kind of property you want to buy. Do you want to buy something which can produce a return on investment straight away and is pretty much done up and you don't need to do a lot of work within that property? Or maybe you are an investor who is looking to increase the value of the property to maybe build an extension, or maybe convert the loft, or maybe renovate the property throughout to, again, add the value and achieve better returns. Again, what we tend to see is that people who are very busy within their kind of job or running their own businesses, they may be very hesitant to buy a big project because that big project will require a lot of work. So if you don't have a right team around you, if you don't have an experience, this is a strategy which is going to involve more risk and more time from yourself. Things to consider as well is whether we are looking to get a repayment mortgage or interest-only mortgage, whether we're looking to buy in our personal name, maybe limited company name. Those are the things which we're going to discuss today as well. They're going to form a part of your strategy moving forward. So if we think about property prices in UK, so just to put you in perspective, from 1952, the average UK house price has risen by 365%. That's even adjusting it on inflation. So what we see with property prices is they may actually go up and down. So if you look at this chart, we had a great period of time when the properties went up and we had decreases in the property prices as well. So from this chart, you can actually see that it's not as easy as it may sound to time the market. Obviously, everyone would like to buy when it's low and sell when it's high. But when we are looking to buy for a long term, we are likely to look at the trends. Obviously, it's going to be great to buy when the market is down, so you can buy it cheaper. However, there is a direct correlation between the property prices and the interest rate. So when the interest rates are low, property prices may go up. So you're getting a cheaper mortgage, but you are buying an asset at the higher price. On the other hand, when the interest rates are higher, the asset price may be slightly lower, and you are able then to compete with less people for the same assets and potentially get yourself a better deal on an asset. And that's the kind of a situation which you see at the moment. So a lot of people will kind of focus on your monthly mortgage payment in terms of how much I'm going to be paying for my mortgage every month. But the true question is, are we looking to stay with this mortgage for a long term, or are we likely to change the interest rate in 2, 3, or 5 years' time? The answer is that we're probably going to stick with the asset, but the finance cost is going to change regardless. So I think it is very important to put that into perspective. And even if you have to pay more on your interest rates, like we currently do, you may get yourself a much better deal on the property moving forward and then change and refinance the deal later on. When investing in properties, you have to think about the rents, because the rent will provide you a return on your investment. And from 1989 to 2023, an annual inflation rate was around 3.71%, which means that rents are actually outperforming the inflation by 0.91% on average. This is a great news for someone who is looking to protect their money against an inflation. Inflation will reduce a potential buying power of your money. But if you are getting a rent every month or every year, which is adjusted by this inflation, you are actually in a better situation than just by saving the money and keeping them at your interest rates, which are variable again. So when investing in properties, you're thinking about the value of the asset, but you're thinking as well about the cash flow and what the rent and the return on investment could be moving forward. It's always nice to think about your vision for investments. Your vision would be a big picture. You would ask yourself, why am I doing this? Why am I looking to actually invest in properties? And some people would say that they are looking just to create an additional revenue streams. Some people would like to minimize the negative effect of inflation on their money. Some people would like to build a legacy for the future generations to provide a better future for your children or loved ones. And some will be thinking about property investing as a alternative maybe to retirement funds or an additional to retirement fund. So not looking at additional stream of income right now, but they may be looking down the line. What's going to happen when I'm going to retire? How would I like my income to be subsidized if I'm not working anymore? So you have to think about your vision, how you want to get there. And we're going to talk about this in length today. So some investors would focus on a cash flow predominantly, and some investors would be looking at a capital growth and capital potential. In my estimation, the best thing is to look at both. So when buying an asset, you have to, or it's good to think about what's a capital growth potential. So how likely is this asset to grow over the long period of time? And what we see, especially in London and in the south of England, that the property prices are more likely to increase than property prices up north historically. We see a bit of a change right now. There's more demand for properties up north, but historically we've always had that scenario where the asset prices in the south or in London were growing higher or quicker than the property up north. But at the same time, the property up north today, because you're buying them at the lower price and you actually getting a less cost, may have a better cash flow. So they may give you a better return on investment every month. So there's always a debate about how the best to service the debt you are getting on your mortgage. So some people will go towards a repayment route, and some people would be paying off only a capital. This is obviously very different than thinking about your own residential home, because you are probably likely to repay the capital and interest on your residential home. But when investing in properties, you got a chance to actually make a decision about which way you want to go. So some investors would like to get a repayment mortgage on their buy-to-let property. In this situation, your monthly mortgage payment will consist of a capital repayment and interest repayment. So each mortgage payment will actually reduce a debt on your mortgage. And at the end of the term, your mortgage will be paid off. For someone who doesn't need a cash flow from the investments straight away, who doesn't need to subsidize their own income or doesn't need an additional income every month, this may be a great strategy. If you've got a sufficient emergency funds to cover any rental voids, then you are guaranteed to repay this asset and potentially plan for your retirement and have a property without a mortgage when you retire. So this could be a great strategy. On the other hand, some people will look at a interest-only mortgage when they actually are servicing only an interest amount on their loan. So that will remain unchanged in this situation. And you have to think about how you're going to repay that mortgage towards the end of the term. So let's look at some pros and cons of having the mortgage on the interest only basis, because a lot of investors will be thinking about this strategy when choosing a repayment vehicle. So if someone is investing in buy-to-let mortgage and is servicing only interest-only mortgage, their monthly mortgage payment will be much lower than the repayment mortgage. It means that there's going to be less stress on the budget for an individual if the tenant's defaulted or you've got a rental void, you've got an empty property. Because what you have to do in this situation is service only a debt without repaying whole of the mortgage. What's quite interesting about most of a mortgages, regardless whether they are on interest only or on the repayment basis, that subject to terms and conditions of every individual mortgage agreement, you are likely to have an overpayment facility, which could be around 10% of your mortgage balance. So you can still actually overpay your mortgage and reduce your debt, but on a flexible terms, on your own terms, without any additional pressure. So just as a simple example, if you've got a mortgage of 200,000, the 5% interest rate, you may be paying £600-700 a month just for the interest only. If you are repaying the capital in interest, you're likely to probably pay about £900 to £1,000 a month. If you're renting that property for £1,200 a month, you're going to be repaying an interest and capital with a £300 surplus, or you're going to be just repaying your interest with £600 surplus. If you decide to pay interest only, you can actually look at open an additional bank account. That's the way I'm actually thinking about property investing. So I've got an additional bank account where all the surplus money are being saved and generated. And at the end of the year, you can actually see how much money you've got left after you've paid all your tax and all your expenses. So for argument's sake, you may have to do a boiler check, electricity check. You may have a little repair here and there, and you paid your interest on the mortgage plus you've paid all the taxes. If you've got a £5,000 surplus at the end of the year, you may actually decide to repay the £5,000 as a capital repayment and reduce your mortgage balance immediately. And you've got another year to make the same decision. So you don't have to repay the mortgage straight away and put yourself in a situation that if there are any rental voids, you have to find a £900 or £1,000 from your budget. But instead, you managing the risk, then you're actually paying less every month, but then making an informed decision about making this capital repayment. And what's great about this capital repayment, the overpayment, is that all of the overpayments will go towards your capital. There's no interest at all. Should you buy under a personal name or a limited company name? This is a huge debate at the moment. And the answer is really, it depends. It depends on your tax situation, it depends on your individual circumstances. It depends as well on your plans and goals moving forward. What is your strategy? Are you looking to get one, maybe two investment properties and use this as a repayment vehicle moving forward? Or are you looking to build a portfolio and expand this strategy? And this will determine what sort of decision you should make. Why is this important today? Before 2017, you could actually offset 100% of your financing costs. So your monthly mortgage payment, interest only, was a fully deductible tax expense, but not anymore. So regardless of your income band, whether if you are a basic rate taxpayer, you're going to have a different ways of claiming an interest rate tax relief. But if you are a higher rate taxpayer, you are no longer able to claim the interest rates as your costs. So if you think about high interest rate, and if you think about paying 40% tax on the full rent amount, for some landlords, after the tax is applied, if they are additional rate taxpayer, this property may not be generating any cash flow and then actually ended up costing them the money. So it is very important to assess your tax situation before making decision, because this will determine whether you should actually go into a limited company structure or whether you should proceed with potentially personal mortgage. So let's look at an example and why this is so important. So let's say if you earn 40,000 per annum, whether this is on the PAYE basis, you're employed, so maybe you've got a self-employed business and you're paying yourself 40,000 a month as a net profit from self-employment, whether you've got a dividend payment and your salary from your company. If your earned income in this situation is 40,000 and you also receive, let's say, 20,000 in rental income, you may have some deductions, some costs associated with running your property. Let's say for this argument, it will be 5,000. And providing there's no other source of income, earned income plus your property income would be in excess of 50,000, would be 55,000. In that situation, you are falling into the bracket of being a higher rate taxpayer. And you are no longer able to claim the costs of financing. It means that you're going to have to pay a tax on the full amount of rent. If you are a lower rate taxpayer, on the other hand, and you're earning below 40% with an addition of the full rental income, you are still able to claim interest rate tax relief. So for a basic rate taxpayer, there's not that much change in terms of the costs of having that property. So you can still reclaim your tax with the 20%. But again, you have to think about the long-term plans, because the full rental amount will be added to your earned income. And if you tip the 40% ratio within your lifetime, you may not be able to claim interest rate tax relief. So this is an example of this. So if a landlord is charging £950 per month for their the rent, and interest is £600 a month, they will have a earned income of 11,400. So this is £950 times 12. That's an income which will be actually added to your self-assessment. And this is important, that this can actually tip the scale. So it's not the profits, it's the monthly mortgage. So it's the monthly rent minus some expenses, not minus the cost of financing, which is a huge cost of having the buy-to-let property. So in this scenario, you will pay 7,200 in interest, and you will get a 20% tax credit if you are a basic rate taxpayer. It means that you will pay £850 of a tax, and there's no changes. On the other hand, if you are a higher rate taxpayer, the amount will double in new system than what it used to be before. So you will pay £3,120 tax if you are a higher rate taxpayer. So this is, as you see, this is a huge, hugely important subject for you to consider. And there are the good and bad things about buying a property in a limited company. So we have to always look at both sides of the coin. The positive thing is that you can actually claim your cost of financing, which can be huge. It's going to be probably slightly easier as well to achieve a sufficient rental coverage within your property portfolios. The lender will always apply a buffer on the rent. So they will always calculate the rent of higher interest rates, and they want additional 25% or even 45% of rental coverage to make sure that this investment is self-financing. When you're buying through the limited company, you are likely to still have the 125% coverage, when if you buy in personal name or under, if you're a high rate taxpayer, this rental coverage is likely to be much higher than that. What's not so great about buying in limited company name is that interest rates and costs are likely to be higher than buying this through the personal. There are additional costs as well associated with running a special purpose vehicle. such as an accountancy costs. So the important thing will be to actually sit down with your accountant and to calculate what is the situation, assess what is my strategy. Am I looking only to get one and repay it, for instance, to have that income during the retirement, or am I looking to buy 2, 3, and 4, and then is it better maybe to go towards limited company route? So those are the things which are very important to consider because they will hugely affect your affordability and your profitability. So how to get a deposit on the investment? The buy-to-let investment may have a quite high and steep entry level as it comes down to deposits and the funds you have to inject into this investment. You may use a savings. Some people will refinance their own property, get their equity out and reinvest in a buy-to-let investment. And some people will be looking at the intercompany loan structure, which we're going to talk about today. So the savings route is obviously an easy. If you've got any savings, you can either inject the savings into a limited company or invest it in your personal name. Some people would be looking at refinancing their own residential property. This strategy was really popular when interest rates were low, because refinancing your own residential property requires you to borrow additional funds, which means that your monthly mortgage payment on a residential property will go up. And your monthly mortgage payment from your residential property is paid after you've made your tax, after you paid your tax from your work, and then you have to pay your monthly mortgage payment on the residential property. So any increase in that mortgage has to be calculated in the return on investments you are getting if you're looking to move the funds to a buy-to-let property. Intercompany loan is a strategy which you can use when buying through the limited company, which we're going to discuss right now. This is an interesting one because as a business owner, you would be generating a profit within your limited company. So if you are a limited company director and you got a net profit at the end of the year, you may pay yourself a dividends every year out of this profit. But if you have a sufficient profit and you don't want to consume that profit, you may think about leaving that money within your limited company. It means that you will probably pay your corporation tax on the profits, but you will not pay your personal tax on dividends or any other proceeds which you take out from the business. So some businesses would be keeping the retained profit within their company, and they may be considering reinvesting that through the intercompany loan, like an SPV company, and borrow that money from one company to the other as a kind of retained profit. What to look out for when doing this? Obviously, you have to talk to your accountant about advantages and disadvantages. When we are looking to grow our businesses, it may not be a great idea to take the money out for different purposes. Some people would like to reinvest this retained profit in the growth of their company, which may be an amazing return on the investment. For some people, when they think about diversifying a risk, they may actually decide to take some eggs from one basket and put it to the other via the intercompany loan. So in order to do this, you would have to have a special purpose vehicle, so the limited company set up outside of your current limited company, and then you can actually facilitate this loan. But not all the lenders will be happy with that scenario. So some lenders will be very hesitant to do that. They are afraid that you actually, in fact, are borrowing 100% of the property value. You are borrowing money from your own limited company to the other limited company, plus you are getting a 75% loan to value mortgage. So not every single lender will be happy with that. It means that it limits the number of lenders who are able to help you with that type of mortgage. So you've got a less choice, potentially higher interest rates for that loan. And some lenders as well would be looking to look at a loan agreement between your one company and the other company, and see what is the projected cost of repaying that loan, and readjust a rental calculation against any additional costs which this intercompany loan may have generated. Although it is a loan between your own company A and your company B, there needs to be a proper structure in place to facilitate that. So the things in addition to that are actually there may be some loan guarantees, personal guarantees, again, additional paperwork required. So what you have to think about is, again, is it worth it? Or is it better to take the money as dividends and just reinvest it in a different way? When building a property portfolio, you have to think about as well the ways you're going to manage that property portfolio. Some people would look at a self-management, and some people will be looking at involving a letting agent. Again, trading your time for money is a great analogy, because some people would like to spend their money to get their time back. The other would be spending their money to save the time. So it is very important for us to see whether we want to actually have a lower return from our investment and save the time, or do we want to spend the time and actually save the money? So self-investment, self-managed route is a route which used to be much more tricky than what it is now. Currently, there are amazing softwares which can actually help you managing your property. I personally use a landlord studio software, and that software allows you to input all your properties from your portfolio within the software, and that software will remind you when is the next general insurance review. So your insurance on the property has to be reviewed every year. Your landlord check, gas check, has to be done every year. Your electricity check has to be done regularly as well, let's say every 5 years. Your contract, where you're renting your property out, needs to be renewed possibly every 12 months. So when you're building this portfolio, you have to think about the additional duties you may have in managing those portfolio. So if you're appointing a letting agent, that letting agent is likely to charge you anywhere between 5 to 10% of the rental income. But then you don't worry about any of the management of this property. They will be likely to be on top of all the new legislation and protect you in some way as well. If you self-manage your property, you have to stay on top of all the changes, which again is actually quite good, I think, to be up to date with the stuff, regardless of whether you've got letting agents or not. So when thinking about property investments, we need to consider various options. We need to think about what's the long-term plan for ourselves. Are we looking to subsidize an income? Are we looking to have a retirement income in place? Or potentially are we looking for that cash flow immediately to help us with our expenses? We have to think about the limited company structure or personal structure, because the tax can heavily affect our profitability. Whether we would like to do it on interest only or repayment is another very important question. This strategy can be changed during the refinancing of your loan, so you don't need to stick with one strategy for a long period of time. You can actually change your strategy along the way moving forward. So you have to think about what sort of return on investment are you looking at? So are you looking at a property which is likely to increase in value, potentially like the properties in London, but they may have a lower cash flow at the moment, so may not generate quite the same returns as the property up north? Or maybe you're looking for the maximum cash flow, so you're looking to retain the difference between your costs and your rent to actually support your lifestyle. So this is a really important question to ask. And how are you looking to manage this portfolio moving forward? All of those things are extremely important. They can be taken into consideration when making those investment decisions. But I hope that gives you a bit of a flavor, a bit of an overview of the important things to consider before actually starting investing in properties. And I'm happy to take any questions. Bart, I'll just stop sharing right now. Thank you very much for listening.
Brilliant, thank you very much. And Greg asked if that recording will be available. Yes, we will distribute that later on. It's quite a lot of comprehensive knowledge, and you managed, right, well, 20 minutes, probably knowledge of someone else's lifetime, really. My interesting comment and observations: trading between return of investment level and time invested. I think this is a very crucial one. We all need and wanted to go quickly and invest, but then we never actually think about how much time we need to spend to manage all of these properties. And you already said about number of compliances we need to have with each single property. If you have one, but imagine having a 3. So it's probably a full-time job, really, and that's another kind of pressure on you, and especially if you have family. We all know how it works. And yeah, so that's definitely things to consider. My observation is also tax. I wasn't aware of the changes, really. I'm not myself property investor, and so that's something that definitely needs to be considered for a long term rather than quick back to in. Really. So that this is my take. But then I think some of the chat flashing. So limited company structure has other benefits like managing income between husband and wife who have different rates of tax. Bożena did mention, and Greg, perfect. It was very knowledgeable presentation. Any other comments? This is now the time, really. Feel free to either unmute or just raise the hand or just use the place to chat for a conversation. Maybe let us know if you are actually investing in the property. How many properties do you have? Maybe you guys are nailing this market and you want to get a little bit more. And before we summarize, Adam, do you own any properties as an investor? Are you investing in properties?
So, Bart, I've started investing in properties back in 2011.
Oh, wow.
So we had an interesting strategy with my wife. We were able to build a property portfolio in Southampton. We had an interesting way, although it's not the way I would recommend to everyone because it was quite tough. We had very limited funds to start with, but our strategy was to buy a property for ourselves, a property which needed a lot of renovation, so we could buy it at a better price, do up this property over the period of time, again, with a limited funds, which I've originally had, and then look out for a new property, again, which needs a renovation. So I was able to add the value to the property I was living in, build an equity sufficient to turn this mortgage into a buy-to-let mortgage, and save enough funds to buy another property, move out to property which needs and requires a lot of renovation.
Wow.
And then do it again and again and again and again. So actually we've moved probably 7 times in the span of 8 or 9 years. So we were quite active in that space. But one of the obstacles when buying a property which is not really rentable, which does need a lot of renovation, is that your rental income prediction on that property will be very low, or the lender may actually treat that property as not suitable for the rental. So in that way, you have to get a different source of fundings. You may want to bridge that property, or you may want a heavy refurb products. Those products can be very expensive in some way. They can be as well very effective for an experienced investor. But we've actually we're able to build an equity through this home renovation projects, through moving out from one property to the other, which was a long journey. I know there are probably better ways of doing this, but for someone who's got a very limited funds, which I had originally, and that was a great way of actually building wealth without a huge amount of funds available.
I mean, this is very, very valid point. I think, you know, it's all depends on the circumstances, and also I get the skills. Did you have any skills yourself to renovate, or you use the other people or network, or maybe your wife is great interior designer and just within 2 weeks they turn into, like, you know, garage into something nice to be live in. What's your strategy here?
Yeah, so because I was working as estate agents back in 2008, 2009, 10, 11, and 12, I've actually had a lot of time which I spent with investors. So I had a lot of knowledge, and I've actually observed people how they're actually doing this. I'm not a handyman, but I need to be honest with yourself. However, when I was actually renovating my first flat, I really wanted to do a few things myself. Although it was very time consuming and the results were not great, I was really keen to see how much time does it take for unexperienced person to actually lay the floor or skim the walls or do some basic tiling, because I was already thinking about investing in bigger picture, and I said, if I'm going to be employing people to do this, I would really want to have a benchmark. I really would like to have some basic knowledge about it, because in that way